income, Robinson.
Hey, how you doing, Gabe?
Pretty good, pretty good. So today we're going to talk about hands-off investing. I call it many other people call it the buy and hold strategy. There's some different strategies within the hands-off investing. I think buy and hold is more like an extreme of that version. And we're also going to talk about
dividend income.
So if you're interested in passive income, then I think this show is for you because we'll be talking about dividend income. If you're also interested in buy and hold strategy, well, it's covered. It's going to be covered within the hands-off investment strategy that we're going to talk about today. So this is the Beyond Return Show, a forum about business, markets, financial planning, and more. And we are here with Montebello Avenue's founder, Robinson Crawford. Robinson is a certified financial planner who serves clients locally and throughout the country. He comes from Phoenix, Arizona. My name is Gabe Kaplan. I'm the founder of Wealth Habits and Strategic Investors, which we'll be launching sometime this year. It's a wealth management firm. I'm a financial advisor. I help people invest and manage portfolios as well as plan for retirement. I'm also a CPA, and lately I've been helping people figure out how to optimize their stock compensation. I learned something interesting now, and I think it's out of our topic, but it's actually pretty important. If you are someone who has a lot of stock vesting in the next couple of years, you live in California right now, and you're planning to move to take advantage of the difference in taxes, if your stock was granted in California, or it could be granted anywhere, but then it vests in California, so meaning that you're getting that economic benefit by working in California, then even if you move out later on, we will still tax you on that portion that vested in California. So it actually has become a little bit complicated because some of these people, I would say the majority of the income is coming from those shares that are vesting, but they moved recently to, New York. And so now they're a residents of New York, and the stock, when they lived in California, it vested all in California. So if they sell the stock, they're going to owe taxes in New York and in California for, it's for the same stock, essentially. New York will give you a credit for the taxes that you paid in California up to New York's rate, right? So if you're paying 15% in California, and then New York charges you only 6%, just giving an example here. It's not actually those numbers, but New York will not give you a credit for 15%. Hell no. They will only give you a credit up to 6%. It's as if you lived in New York, right? So you will get credit for that amount. But you still have to pay the California one to California. So you'll be paying a little bit more. It sucks. It really does suck. When I tell you what is a hands-off strategy of investing, what do you think? What comes to mind first?
The first thing that comes to mind for me is the idea of a risk premium or risk premia, maybe they call it. I don't know what the academics say. But the theory here is that there should be some sort of premium, meaning a payoff associated with holding things that are risky, owning things that are risky. And of course, there are different risk premiums associated with different types of risks. So the credit risks of owning investment grade bonds should not be as high as the risks of owning emerging market stocks, be an easy example. But that's what comes to mind with buy and hold is the attempt to go and capture some sort of risk premium and harvest it over time by holding.
One question I have is that risk premium changes over time, right? So how do you account for that in an investment strategy that's buy and hold?
Yeah, you should change your expected returns is the main piece there. There's a lot of ways and a lot of different models available for free of how investors calculate expected returns. Most of the time that's a decent idea of what the risk premium associated with holding one asset class or another.
Yeah. I associate hands-off investing as like buying vintages of wine. You buy 1 year, the second year, the third year, the fourth year, like the vintage. And then, after 7 or 8 years, you should look at the first one to see how it came out. The problem that I encounter is that, let's say today you go and buy and hold for next 10 years. Some things are going to be cheaper than others. I would say right now, after this tech debacle that we've had in the last 2 weeks, some tech companies appear to be reasonably priced. If you had come to me in mid-February, I would have probably bought opening stocks, like some of the stocks that were to be opened. Or like if with the rising rates, I think financial stocks are going to be really good. So all I'm trying to do here is capture a good entry price for the companies I am, and then I want them to evolve, for the next 3-4 years to take advantage of that. Hopefully, the pricing will fix itself. In other words, the pricing will, I would say, normalize, and then sell then, or I don't know, that I'll make a decision afterwards.
I think a lot of people are going to associate buy and hold with, we went to like funny, weird examples, but a lot of people are going to associate buy and hold with just index investing, right? With using index funds, using index strategies. It sounds like what you said is that your issue with buy and hold is that if you just buy everything, if you buy the index, you're going to buy the expensive stuff and the cheap stuff, and you're not really going to take advantage if you have a view in one way or another.
Exactly. I would say it's like going to the supermarket and seeing some stuff that's on sale. And you tend to overweight those things, right? With buying an index, you can't really overweight those things. In fact, you're underweighting them because the index, it's market weighted, so it will underweight the cheaper ones.
Right.
And that's kind of like the problem with the indexes. But overall indexes are still pretty good. And the reason why I think they're very good is because they rebalance internally for you. You don't have to go in and rebalance or fix stuff afterwards. You could just buy the index and that's it.
They do rebalance internally. They also reflect. I like to think of indexes as an admission that the market itself is really smart, right? Markets are highly efficient and really smart.
Which they are. I totally agree they are.
And the choice to buy an index, maybe not the whole index, maybe it's pieces of the index, is a choice to incorporate that reality that markets are extremely sharp, and you're unlikely to, you're going to have a hard time, especially in certain markets, doing better than just buying and holding and grabbing that risk premium that's associated with the market over time, which, as you said, has been great, right? The historical risk premium. Of course, that's not what we're guaranteed going forward, but historically, that's looked awesome. Buy and hold small caps or large caps. It doesn't matter. A lot of these risk premiums have really paid off with patience, but it's hard to do for all the reasons that we talked about.
Exactly. And the risk premiums, as we said before, they vary over time. So, and that has to do also with price. So the expected return when the price goes down. So if the price goes down, the expected return is actually going to go up. The one thing I want to say is ETFs, the downside again is that they will invest in things that are expensive or have gone up in price, and they're more outweighted in the market. But the good part is that they update themselves as the market evolves.
I'm going to push back on you there. There's ETFs that buy cheap stuff too, right?
Yes. I wouldn't call them though completely passive though. They have an element that are.
But if we're defining it as buy and hold, there's definitely like people who just like there's investors who held the Fidelity Magellan Fund forever, right? Who was it? Was it Lynch who ran that?
Yeah, over a bunch of years now performed.
Right, right.
Which book did he write?
He wrote a bunch of them, but
the big one is like One Up on Wall Street, I think it was called. Amazing one. Highly recommended.
To you, is someone who goes and buys, like in their retirement fund, all they do is buy the Magellan Fund from 1986 to 2012. Does that count as hands-off investing strategy? To me, it does. If all they did was do that. So there's so many ways to, using funds. It doesn't have to be a passive fund. Active funds count as buy and hold too. I'd like to think of the distinction as when you yourself as the investor are not doing the management. And there's a good corollary with real estate here. So like in real estate, you could buy a home, on one end of the spectrum, be totally an active manager of rental real estate, right? You're the landlord, you're the plumber, you're the painter, all this stuff. And on the other end of that, you can buy a REIT on a stock index, and you couldn't be more far removed from the management of that product, right?
Yeah.
So there's a spectrum in between, right? You can do some amount of management. Say you're responsible for rebalancing, or you trim or change your model once a year. Maybe that's something in the middle. Yeah. True buy and hold. You can buy and hold almost anything. Not all of it's a good idea.
So let's move on to next topic, which is dividend income strategy here. And there's a lot of things to talk about, but I just want to name them quickly. One is, we should talk about passive income. The other part, which is holding period, and that relates to taxes, diversification, and also, methods of monitoring that kind of portfolio and ways of reducing risk. And then I want to talk about, with related to holding period, qualified dividends, the taxation of dividends, and also how that is reported in your tax return. And finally, some other catch-all, which is like how other types of dividends, what kind of other types of dividends exist. So let's start with, I guess, dividend income and how it relates to passive income.
Yeah, my favorite way to do this, and I'll share this so that we can put it hopefully as a visual for this video, but I like to think of dividend income. I like to just show a spreadsheet of, all right, if you invest $1,000 and you hold it for a year, how much dividend income can you earn in a simple strategy, right? Not you going out and getting extremely complex, but largely buy and hold, right? If you buy and hold some dividends, how much yield can you earn, and what does that mean on different amounts? And I find this gets investors really interested in the savings aspect, because they're like, okay, at $1,000, that doesn't produce that much dividends. And even with some tax advantages, it's not that great. But at 5,000, it gets more interesting. At 10,000, it gets more interesting. And then you can relate whatever that income is to an expense that they have. So you could make a dividend income strategy where you say, look, all I want to do is have my dividends pay for my car insurance, right? You can match these things up. So that's my favorite way to think about them.
And then you raise the bar, right?
You keep raising that bar until it's paying for, first class flights to Dubai for you to live at the Burj Khalifa. Yes.
If you were invested in oil right after the pandemic, your dividend yield would have been extremely high. Now, where's oil going in the next 25 years? I don't know. Not in a good place, right? I don't know. Specifically with the rise of the electric car. But, passive income in itself is something that I think most people should strive to get some sort of. It reduces the risk of, running out of money or, getting in a bad place if you have some sort of safety net. And that is essentially the passive income portion.
Do you think that a company paying a dividend, all else equal, is a indication of financial strength or defensiveness compared to a company that's maybe a little riskier?
I would say the volatility, and this is just mathematically, I think the volatility of the stock price will be less.
For dividend paying stocks.
You're getting part of that return in cash flow to you sooner than later on.
And it's definitely associated with more mature companies, right? Fast-growing, youthful companies are not paying dividends because they think they have better use of the capital, right? They think they can do better.
And this is something you should always monitor at the company, how to reduce risk. It relates to that issue. Is like if the company that you're investing in is not able to reinvest all the capital they generate, they should start paying a dividend or buying back stock, whatever they choose to do, but they should be doing one or the other. If you see a company having excess cash flows and making like weird acquisitions, or not acquisitions that are pretty much a little bit expensive or outside the core competencies, then I would be a little bit worried, right? So you want to monitor, revenues of the company. If the revenues are going down, then it could mean at some point that the dividends will have to go down. You should monitor the gross profit margins. They should remain stable or increase. The operating margins, also the reinvestment rate, and with that is, if you have $100 in cash flow, you really have two options. You reinvest that capital or keep it. That's the same thing for a company, or you pay it out, and you pay it out via stock purchases or dividends. Those are the two ways you return capital to shareholders.
Dividends are not guaranteed. Dividends can be nice, but dividends are not remotely guaranteed. They are subject to risk, along with your risk of your principal for what price you pay for the company. So this is not although dividends, like I mentioned earlier, can be a signal of defensiveness, they are not. I wouldn't passively just say, oh, I have dividend paying stocks, they're safe, right? My dividends are safe and my stock, what I paid for them is safe. That's simply not the case. What's a qualified dividend and what's a non-qualified dividend?
A qualified dividend is it's a dividend that from a company that has specific characteristics, and one of them is that it has to be I think it has to be a U.S. company or traded in a U.S. stock market, right? I think you can have a U.S. company that's trading in a foreign exchange, and that wouldn't be qualified. It would have to be, I believe it has to be a U.S. Company trading at a U.S. exchange, and then you have to qualify via holding period.
So there's a holding period. There's also a select list of companies. Not every company in the world. It should, for U.S. taxpayers, generally U.S. companies.
So just looked it up here. The IRS says at least 61 days during the 121-day period.
So if you want good tax qualified treatment on that dividend, you should own the stock 60 days before the ex-dividend date, which should be well cataloged. You can find it easily for any company.
But for certain preferred stock securities, you must have held the stock for 91 days out of the 181-day period beginning 90 days before the ex-dividend date. What is a little bit more tricky, though, is making sure that whatever company you buy isn't like an ADR, an American Depository Receipt company. So it isn't foreign companies that trade in the U.S. markets and have, I would say, that they're ADRs. How do you explain an ADR?
An ADR is a coupon, not a coupon, but like a ticket for a foreign company that trades on U.S. stock markets. It's an equivalent.
Exactly. And so those would not qualify.
That's right.
For a qualified dividend. So you're going to end up paying, I think it's like ordinary rates on those, right?
That's right. You'll owe ordinary tax on non-qualified dividends, and on qualified dividends, you'll get better tax treatment. They'll treated generally as long-term capital gains.
In terms of diversification here, if you were to build a portfolio that spits out, a large amount of dividends, which industries would you focus on? How would you diversify it? How would you actually go ahead and build one?
Good question. I personally don't do this. I don't run a dividend-focused strategy, nor do I advise clients to do so. So don't count me as an expert here. I'll start with that. The way that I like to think about dividends is a byproduct rather than a focus. Dividends are a byproduct of certain portfolio construction approaches. A quality factor would be one. Maybe a shareholder yield would be another. Shareholder yield you can think of as a combination of dividend yield and share buybacks.
Yeah, I think repaying debt is considered also.
It depends who you ask. Some people would say that net debt pay down does count. Some people would leave that out. But I usually construct portfolios thinking of factors other than dividends. I don't think dividends themselves are a very good factor. I think it's flawed to focus just on dividends. So if I were going to create one and someone really wanted just good dividends, I would be looking at quality, like return on invested capital. I'd be looking for strong balance sheets and value, low multiples of what I think the future business can do.
It's hard. I will say though that good dividend yields are hard to come by in companies that have growing revenues. So when you see high dividend yields, there's no growth there, and it's worrisome. The other part that's really worrisome is when the payout is larger than it's like 150% payout. Like, it doesn't make sense. Are they taking out a loan to give out the dividend?
Explain that in plain English.
Sometimes the payout ratio is higher than 100%. So that means that let's say they have a free cash flow, right? So it's based out of cash flow from the business, the payout. And if it goes above 100%, then they're going to have to take out money from somewhere else to pay for those dividends. And so what companies have done in the past is that they've taken on debt to pay those dividends. They've also taken out debt to do share buybacks. That's all in the news.
Why would a company be doing this?
I call it financial engineering.
Yes. To what end? What is management gaining from keeping that dividend high?
There's a certain investor base that likes the dividend, and so if most of their shareholder base is dividend appreciate, like if they are happy to have a dividend, they will push for this. It isn't long term suitable because these shareholders will likely, when the moment is that they can't pay the dividend anymore, they're just going to sell the stock and move on, right? Leaving the company indebted to the next shareholders. I don't think it's a sustainable good practice for corporations should have stability, and this actually erodes that kind of stability, this behavior.
I'm glad you brought that up. This is maybe my favorite thing to explain. It's hard to explain. It doesn't make a ton of intuitive sense, but dividends are like a carrot on a stick. And many companies are manipulating dividends in an unsustainable way, in exactly how you've described, in order to lure investors into thinking they're earning a healthy yield when that yield is not sustainable, and you're actually very much risking the principal or what you put into the stock in order to do that. So these companies are sophisticated. They're playing games too. Dividends are not free. It's not free money. It comes with a risk. It has its own risk premium too. So beware of payout ratios. That's a great, just immediate red flag. Hey, this company can't, at current rates, cannot afford to sustain this dividend. That should be a big red flag for anyone who's focused on this.
I will say, though, that certain companies will not be able to pay. Their payout ratio will spike above 100% in bad times. For example, oil companies right after the pandemic started, they probably all had payout ratios that were higher than 100%. But then they have to go back and reevaluate whether or not they can sustain it in the long run. And as you said, Royal Dutch Shell came out to the conclusion that it wasn't good. It hurts them in the long run to take out debt to pay the dividend. This is not an investment strategy for a company that's probably worthwhile. Final thing that we should talk about is how is this reported in the tax return? There's two places where the dividend should show up in the tax return mainly. Like I guess there's more places, but two big places. One is in the 1099. What is it called? The 1099B. Yeah, in the 1099B.
B for brokerage.
That's where they should show up, and the other part is in the front page of the tax return, where you should be able to say dividends, and then there's a special box that says like how much of these dividends were qualified. If they're qualified, they will carry the long-term tax rates. Remember, states don't give a crap whether you are a long-term investor or short-term investor. They want to charge their single high rate to you. If you live in Florida, you don't have to deal with this. If you live in Texas, obviously, also you won't have to deal with this. If you live, though, in New York, California, or any other state that pays taxes, then you're going to have to deal with this.
Also, net investment income tax.
Oh, it's actually part of that. Yeah, that's true.
The federal rate.
If you're married, the limit is 250, right? And if you're single, it's 200, and it's of your total income. If your total income is above 200, then from then on you pay an investment income tax, right?
Yep, of 3.9%. So for most,
3.9 or 3.8?
I can't remember. I think it's 9. For most people, I'm assuming if they're in a high earners, high tax bracket, that qualified dividends and long-term capital gains are going to be taxed at 23.9 federal.
It's 3.8, so it's 18.8 and then 23.8. Oh, there's one other topic. What are other types of dividends?
I mean, I would loop in interest income kind of roughly in here, right? If you buy a bond, it's going to feel like a dividend. It's a payout, right? But that's interest income. That's definitely not taxed at qualified rates. We can get into bond income taxation. There are dividends that are non-qualified from U.S. companies, so like REITs do not pay qualified dividends because that's REITs is real estate investment trusts. They don't pay any income tax at the corporate level, which is nice. But their taxpayers get generally hit at full rate. So those are not qualified dividends. And then the foreign dividends that we talked about too.
But the REITs, the good part about the REITs is that they avoid that, as you said, that they avoid the corporate tax, right? It goes directly from income to your tax return. Whereas, from a regular corporation, they have to pay tax first, and then they issue the dividend.
Right. I guess the last piece you could put here is for people who are either investing in partnerships or buying partnerships on the stock exchange, because there's still plenty of publicly traded partnerships.
Yeah,
that's a different type of dividend, and that's one that people can get really tripped up on. Master limited partnerships, for example, those pay high dividend rates. If you buy those without knowing what's going on, you may be in for a tough surprise at tax time. They're subject to a totally different regime because they're partnerships and not corporations. That distinction is surprisingly important.
I will say, as a guiding conclusion, the way you mix these two up is you can buy a hands-off strategy of dividend income.
It can be done. These two can be combined into one powerful middle of the Venn diagram of today's episode.
And that will likely lead to. I'm guessing this is kind of what the FIRE community does, right? So
I think the FIRE community is heavy index fund people. I don't know that there's so much of a dividend.
I got it, but like they do, I think, still a lot of. I know a lot of them who actually do
dividend
buy dividend. Yeah, they use it as income replacement. They try to get to the amount of. First of all, their spending is like very cheap,
quite low.
Yeah, well, they're all dinks, right? Dual income, or
dual income, no kid is
no
that
kids.
Yes,
and they used to be mobile. These used to be remote workers before remote was a thing,
right?
And so they would live in these very inexpensive areas of the country with no kids, and so their cost of living was pretty low. So you can replace your income. It's much easier than if you live in the Bay Area.